All right, here is a all-in-one simulation based on a rate and term refinance. When it comes to all-in-one on primary homes, whether it's a purchase or rate and term refinance, you need 10% equity, meaning 10% down to purchase or 10% in equity when you refinance it. If you do a cash out refinance, you're looking at 80% loan to value. That's the max you could pull out on that. Second homes investments, purchase those 20% down. Cash outs are max 70% loan to value. So you need at least 30% equity there. So here is a simple scenario for the rate and term. We're going to say home value is 775, and let's say we're going to take out $670,000 just to pay off the existing mortgage, versus doing a refinance at 6.5%. This scenario, we're going to say borrower is bringing in about $15,000 a month after taxes. We say that's monthly. And then as far as expenses, $775,000 loan, you're probably looking at about, let's say, $450 a month in taxes and insurance. So this simulation counts the mortgage and obviously the taxes now. So after it calculates the interest-only payment, it says, okay, this is how much we have left over. So now we're going to go through and we're going to see how much expenses you have for the month. So aside from your mortgage, let's say there's some car payments, gas, utilities, food, whatever. Let's just say you have about $5,000 left over. So $5,000 on top of your mortgage each month is your expenses. So with that $5,100 left over, we're going to calculate the results. Now on the all-in-one, it's showing that you would be paid off in 8.4 years without making any extra payments versus the 30-year loan, the standard, traditional, conventional at 6.5%. The amount you would save doing this loan, if you went to term on that one, would be $600,000 almost. Now, when I say went to term, that would probably be your best, the least amount you'd pay, because every time you refinance, you could be kicking the can down the road and paying more fees or interest, extending your payoff period. And the longer it takes to pay it off, the more interest you're going to pay. So this is the best case scenario. If you were to pay that off in 30 years at 6.5, or you did the 8.4 years with the all-in-one and didn't make an extra payment. Now, what you're asking, how do I not make extra payments and still pay it off faster? Well, the all-in-one loan is a bank account and mortgage all in one. So each night when you deposit money into that account, your checking account, at midnight or sometime in between the closing hours and whatnot, it sweeps that money into your mortgage. So let's say you deposited $10,000 in there today. When it does its nightly interest calculation, it looks like you just made a $10,000 principal payment, so you're paying less interest because there's more principal. All right, now you could spend that $10,000 the next day if you wanted to, but ultimately we're looking at an average monthly disposable income of $5,000 in this scenario, which would just kind of stay in the bank. And the less interest it takes out each month, the more principal it leaves in, meaning the following month, the calculation is even less. So let's look at the pay down summary on this. So on average, your monthly payment, meaning the interest drawn out of the account, was $25.85 versus your actual payment of $42.34. Average principal reduction. You're applying on average over those 8 years, $6,600 a month towards principal. On this case, you're over 30 years, your average principal is $1,861. That's the best you get. Here's the magic here. APR. Your effective APR is only 2.324 versus what you signed up for on that fixed 6.5 rate. So how's the APR so low? Well, back when all the mortgage crisis and there's so many bad loans out there, they said, we want to make sure that APR is on everything because that is the true cost of the money borrowed. Well, the key factor in calculating APR is time. And when they put 30 years in, that's how they lower their APR. So someone come in and say, hey, don't take that 6.5 rate that that bank's offering. I can get you a 5.5 rate. It's just going to cost you $25,000 in points. And then he does the calculation. Because it's over 30 years, your APR comes back at, let's say, 5.9. They're like, oh, that's still way lower than 6.5. I'll pay the 25,000. Well, you're probably not going to go a full 30 years. You'll probably refinance as maybe a year or two. And let's just say you sell it or refinance it in 8 years. If you recalculate your APR for the money borrowed and what you spent and what you owe at the end of that, your actual APR is going to be up near 20%. Okay, so it's kind of a smoke and mirrors. Yes, they wanted you to have a true idea of the cost of mortgage for 30 years, not based on a short-term loan. So that's why your APR on this product would be much less than going with a 30-year fixed traditional. And all you did was go by your budget. Again, we calculated expenses and we just left the money in there. And this is a bank account. So you could have direct deposit coming in, you can have ACHs, bill pay, you can wire, you can transfer to other banks. It is just a bank account. You'll even get a debit card. So let's look at, here's the other piece, the rates. Your APR was down around 2%. But the actual rate for this product, if we were to close today, would have been 8.3, worst case scenario. How they calculate that is the index, the SOFR index. They take the 30-day average. So at the end of each month, your rate is different and it should be lower each year for the next few years. So 4.3 was the average. And then you get to choose your margin. You can buy it all the way down to 2.5 before close, or you can leave it at the standard 4. So that gets us to 8.3. But again, even at 8.3, not making extra principal payments, just living in your budget, you actually got down to a 2 whatever it was in the twos for your effective APR. I'm going to show you another thing. Here's your pay down table. So this is the money available to you in your all-in-one account, your mortgage account. So let's say we fast forward to month 24, you have $118,000 available. You could invest that. You could buy another property with it. You could go on vacation, pay off bills, buy a truck, do whatever you want, pay for school. That money's there. So you're really financing everything going forward. You're just putting your own bank name right on top of your house. So let's just kind of look at that. So we know, let's go back to the results. We know that 8.4 years paid off, just going by budget on a 2.324 APR. If we were to turn this into an investment bank, your home turns into an investment bank. And let's say we spend $100,000 every couple years for the next 6 years. So let's go 24. Let's spend another 100,000 in month 48 and month 62, 72. All right. So what I'm doing here is I'm saying, okay, we're going to take $100,000 out of the account on year 2, year 4, and year 6 to buy additional properties. We're going to look for something around 400 that could yield a good return. We're going to put $100,000 down and it should rent for at least 125% of what your mortgage would be. So a DSCR would be a great product, debt service coverage ratio, to where you don't have to show any income at all. You just put $100,000 down, and because the rent is there, they'll fund the loan at a really good rate. So 3 homes in 6 years. We're going to calculate results. All right. Now, in 13 years, your primary home is paid off. You'll have $670,000 in the account. And you will also have 3 other properties paying additional return. So let's just say they're breaking even, but they're appreciating and your wealth is increasing and you're still not putting anything extra in. You're just going by your budget. Everything comes in and out of this account. whether they're expenses or taxes or insurance on any of your properties, the money's there and available, and you just treat this, and this account builds your portfolio for you. We didn't put any extra income in there. If there's more income, you get even better results. Go down to the pay down summary. So now, over 13 years, you have 4 homes now, not just the one. Your one is paid off, and you're still at a much better effective APR than that 6.5 over 30 years. So you could see 30 years, one house paid off, spend extra $60,000 or $600,000, or 13 years, one house paid off, and 3 other properties generating income for me. So this is not for everybody. It's not for, paycheck to paycheck. You got to have at least a couple $1,000s left over in disposable income, meaning you're efficient with your income. And you got to look at it not rate focused, but cost focused, because the amount of money saved doing it this route is probably in the millions at this point. 15 years into this, we stopped buying houses at 6 years. 8, 10, 12 years in, more income coming in. Now all of a sudden you got 6 properties in 15 years and paid off. So this thing, sky's the limit with this. So like I said, not for everybody. You need a 700 credit score, and it's the same as any conventional loan. 43% DTI is the highest DTI we can use. And then we'll also need reserves. So if we're at 40% DTI and your loan amount is 670, we'd need to show $67,000 somewhere, like 401ks, IRAs, stock markets, bonds, life insurance, if there's a value on your life insurance, savings. We can use all those to count as reserves. You don't need it to spend. It just needs to be available. So consider this, and if this is something that intrigues you and might make sense for you, reach out. Let's do a Zoom and do your exact scenario for you. All right. Thanks. Have a great day.